Welcome to Dr. Chris's Key to the Manager's Mindset video series on personal development and productivity improvement. We are absolutely thrilled to have you join us on this empowering journey. Our mission in this series is to unlock the potential within you, and today we are going to focus on a key aspect of personal development: financial literacy. Investing is a skill that can lead to incredible growth, not just financially, but also in terms of your strategic thinking and decision-making abilities. Today, we are about to embark on an exciting expedition into the realm of investing. We will explore the territories of stocks, bonds, and mutual funds, unearthing their secrets and illuminating their potential risks and rewards. So buckle up, dear viewer, as we gear up to delve into the world of investments, equipping you with the knowledge to navigate your financial journey with confidence and wisdom. By the end of this video, you'll be a step closer to mastering the manager's mindset. Let's get started. Hello everyone, I hope you're having a fantastic day. Today we're going to delve into the world of investing. It's an exciting journey, one that can lead to significant financial growth if navigated wisely. Understanding different types of investments, their benefits and potential risks is crucial. It equips you with the knowledge to make informed decisions tailored to your financial goals. By the end of this video, you'll have a solid understanding of three key types of investments: stocks, bonds, and mutual funds. First up, we have stocks. But what exactly are stocks? Well, think of a stock as a slice of the financial pie that is a company. When you buy a stock, you're essentially purchasing a piece of that company, making you a shareholder. It's like buying a small piece of a gigantic cake. You might not own the entire cake, but you do have a share of it. Now, there are two main types of stocks: common and preferred. Let's break them down. Common stocks are the most prevalent type. Owning common stocks gives you the right to vote at shareholders' meetings and receive dividends, which are a portion of the company's profits distributed to shareholders. The more shares you own, the larger the slice of the profit pie you receive. On the other hand, preferred stocks are a bit different. Preferred shareholders have a higher claim on the company's assets and earnings. This means if a company goes belly up, preferred shareholders are paid off before common shareholders during the liquidation process. Also, preferred stockholders generally receive dividends before common stockholders, and the dividends are usually higher. However, preferred shareholders typically don't have voting rights. But why would anyone want to own a piece of a company? Well, there are a few reasons. For one, if the company does well, the price of the stock goes up, and you could sell your shares for a profit. Also, some companies pay out dividends, so owning their stock can provide a steady stream of income. However, it's important to note that stocks can be risky. The price of a stock can go down, and if the company goes out of business, you could lose your entire investment. So, investing in stocks requires careful consideration and research. So, in essence, when you buy a stock, you're becoming a part owner of that company. It's an exciting prospect, isn't it? But remember, with great power comes great responsibility. So make sure to do your homework before diving into the world of stocks. Now, you may wonder how stocks work. Well, let's start by understanding that stocks are traded on exchanges, such as the New York Stock Exchange, NASDAQ, or the Nigerian Stock Exchange. These exchanges are like vast digital marketplaces where buyers and sellers meet to trade stocks. When you think of buying a stock, you're essentially buying a piece of a company. A company issues stocks to raise capital for various reasons. Maybe they want to expand, invest in new projects, or pay off debt. As an investor, when you buy a stock, you're buying a share of that company's future profits and assets. But here's the catch: the price of a stock isn't static. It fluctuates throughout the trading day. Imagine a giant seesaw with the stock price in the middle. On one side, you have buyers. On the other side, you have sellers. The balance between these two groups determines the stock's price at any given moment. The price of a stock is influenced by a multitude of factors. Company performance is a big one. If a company is doing well, showing robust earnings and promising prospects, investors will want to buy the stock. This increased demand can push the stock's price up. On the other hand, if a company is underperforming or there's negative news about the company or its sector, investors may want to sell their shares. This can drive the stock's price down, but it's not just about the company. Broader market conditions also play a role. Economic indicators like employment rates, inflation, and even geopolitical events can sway investor sentiment and impact stock prices. Here's the key takeaway: when you buy a stock, you're not just buying a piece of a company. You're placing a bet on the company's future performance and the market's perception of that performance. Thus, the price of a stock is a reflection of the company's performance and market conditions. Stocks can be lucrative, but they also come with their share of risks. Let's delve into the exciting world of stock investments. One of the most enticing aspects of stocks is their potential for significant returns. When you purchase a company's stock, you're essentially buying a small piece of that business. As the company grows and prospers, so does your investment. Over time, this can lead to substantial growth in your portfolio. It's like planting a seed and nurturing it to grow into a towering tree. But what's the catch? Well, the stock market is unpredictable and can be influenced by a myriad of factors, ranging from economic indicators and geopolitical events to company-specific news. This volatility, or rapid and significant price swings, is a fundamental risk associated with stock investing. In other words, just as stocks have the potential to provide significant gains, they can also lead to substantial losses. Another risk is the lack of dividends. Some stocks, particularly those of newer or rapidly growing companies, may not pay dividends. Instead, these companies often reinvest profits back into the business for further growth. As an investor, this means you're primarily banking on the stock's price appreciation for returns, which is not guaranteed. Despite these risks, many investors are drawn to stocks because of their potential for high returns. And it's worth noting that historically, stocks have outperformed other investment classes over the long term. But the key phrase here is long term. Investing in stocks is not a get-rich-quick scheme. It requires patience, research, and a well-thought-out strategy. Lastly, it's important to remember diversification. By spreading your investments across a variety of stocks in different sectors, you can lower your risk. Think of it as not putting all your eggs in one basket. While stocks offer the potential for high returns, they also carry a degree of risk, and it's critical to understand this. So before you dive headfirst into the stock market, ensure you're fully aware of both the advantages and the risks. After all, knowledge is your best defense in the unpredictable world of investing. So, how can you get started with investing in stocks? First off, you'll need to set up a brokerage account. This is the platform that will facilitate your buying and selling of shares. There are many online brokers to choose from, so it's important to do some research and find one that suits your needs. Look for brokers that offer low fees, a user-friendly platform, and a wide range of investment options. Once you've set up your account, you're ready to start trading. But wait, don't rush into buying just yet. It's crucial to do your homework first. That means researching the stocks you're interested in. You'll want to look at the company's financials, their performance over the past few years, and their future prospects. There are plenty of resources available online to help you with this, including financial news sites, investment blogs, and even the company's own websites. Now let's talk strategy. As a beginner, it might be wise to start with index funds. These are funds that aim to mirror the performance of a specific stock index, like the S&P 500. They offer instant diversification, as you're essentially buying a small piece of each company in the index. Speaking of diversification, it's another key aspect of investing in stocks. Don't put all your eggs in one basket. Spread your investments across different companies and sectors to mitigate risk. If one stock performs poorly, hopefully, others will do well and balance things out. Finally, be patient. Investing in stocks isn't about making a quick buck. It's a long-term game. The most successful investors are those who buy and hold, riding out the market's ups and downs. Remember, investing in stocks is a journey, and it's important to start with a solid foundation. Take the time to learn, do your research, and develop a strategy that works for you. Happy investing. Moving on, let's discuss bonds. Now, if stocks are like buying a piece of a company, think of bonds as lending money to that company or to a government entity. Yes, you heard it right. When you buy a bond, you're essentially playing the banker role, lending money to these organizations for a set period of time. Let's break it down a bit further. Bonds are essentially IOUs, promises to pay back a certain amount of money at a specific time in the future. This future date is known as the bond's maturity date. Along the way, the issuer also agrees to pay you interest, typically twice a year, until the bond reaches maturity. Now, there are different types of bonds, and each comes with its unique characteristics. First, we have government bonds. These are issued by national governments, and they're often seen as safe because they're backed by the full faith and credit of the issuing country. In the United States, for example, we have the Treasury bonds, notes, and bills. Then we have municipal bonds. These are issued by states, cities, or other local government entities to fund public projects such as schools, roads, and hospitals. These bonds can offer tax advantages, making them particularly attractive to certain investors. Lastly, we have corporate bonds. As the name suggests, these are issued by companies. Companies issue bonds as a way to raise money for various purposes, like funding operations, paying off debt, or investing in new projects. Corporate bonds typically offer higher interest rates compared to government and municipal bonds, but they also come with higher risk. In essence, bonds are all about balance. They provide a way for investors to earn steady income while taking on less risk compared to stocks. But remember, less risk doesn't mean no risk. It's essential to understand the issuer's creditworthiness before buying a bond. Thus, when you buy a bond, you're essentially lending money to the issuer for a certain period. Let's look at how bonds work. In essence, a bond is like an IOU. When you purchase a bond, you are essentially lending your money to a corporation or a government. In return for this loan, the bond issuer promises to pay you back the amount you lent, known as the principal, at a specified future date, known as the bond's maturity date. But that's not all. The issuer also agrees to make regular interest payments to you for the duration of the loan. These payments are often referred to as the bond's coupon rate. Now, the interesting thing about bonds is that they don't just sit in your investment account collecting dust until the maturity date rolls around. Bonds can be bought and sold in the bond market, much like stocks in the stock market. This means that the price of a bond can fluctuate based on supply and demand. If a lot of investors want to buy a particular bond, its price goes up. Conversely, if many investors are selling the bond, its price goes down. Another key factor that affects bond prices is interest rates. When interest rates rise, bond prices typically fall. Why? Well, think about it. If new bonds are being issued with higher interest rates, then the older bonds with lower rates become less attractive. So, their prices have to drop to make them competitive. On the other hand, when interest rates fall, bond prices usually rise. Finally, let's talk about yield. The yield of a bond is essentially the return you can expect to get from your bond investment. It's calculated based on the bond's price, its coupon rate, and its time to maturity. When bond prices go up, yields go down, and vice versa. So the interest rate, bond prices, and yield are all interconnected in the world of bonds. Understanding these relationships can help you make informed decisions about your bond investments. What are the advantages and risks of investing in bonds? Bonds, my friends, are often seen as the steady, more predictable sibling in the world of investments. They're the tortoise to the hare of stocks, if you will. Slow and steady might not always win the race, but it sure does provide some stability in a portfolio. The primary advantage of bonds is their stability. When you buy a bond, you're essentially lending out your money to a corporation or government entity. In return, they commit to pay you a fixed rate of interest over a certain period until the bond matures, at which point they return your initial investment. This predictable income stream can be a comforting presence, especially during turbulent market conditions. Moreover, bonds are income generators. The regular interest payments, or coupons as they're called, can provide a consistent income stream, which can be particularly appealing for retirees or those looking for a more predictable return on their investment. But before you go all in on bonds, it's important to understand that they aren't risk-free. Let's talk about two main risks associated with bonds: interest rate risk and credit risk. Interest rate risk is the risk that the value of a bond will decrease due to an increase in interest rates. When interest rates rise, newly issued bonds come with higher coupon rates, making existing bonds with lower rates less attractive, and thus, their market value decreases. Credit risk, on the other hand, pertains to the bond issuer's ability to repay the loan. If a company or government entity runs into financial trouble, they might default on their payments. This risk is usually higher for corporate bonds than for government bonds, as corporations are generally more likely to face financial difficulties than stable government entities. Bonds offer stability and regular income, but it's important to be aware of the risks involved. Just like any other investment, it's essential to do your research, understand the risks, and consider how bonds fit into your overall investment strategy. So, how can you start investing in bonds? Well, the first step is to set up a brokerage account. This is the platform through which you'll be buying and selling your bonds. There are plenty of online brokers out there, so take some time to research and find one that suits your needs best. Once you have your brokerage account set up, the next step is to do your homework. Just like with any investment, it's essential to know what you're getting into. Start by understanding the different types of bonds available. Government bonds, municipal bonds, and corporate bonds each have their unique characteristics and risks. Government bonds, for example, are considered very secure but may offer lower returns. Corporate bonds, on the other hand, can potentially provide higher returns, but they come with a higher risk. Municipal bonds are often free from certain taxes, which can be a significant advantage depending on your tax bracket. In addition to the type of bond, you'll also want to consider the bond's rating. Ratings agencies like Moody's and Standard & Poor's grade bonds based on their creditworthiness. A higher rating means the issuer is less likely to default on their payments. Another key factor to consider is the bond's yield. The yield is essentially the return you can expect to get on your investment. However, remember that bonds with higher yields typically come with higher risk. The term of the bond is also an important consideration. Longer-term bonds are more sensitive to interest rate changes, which can affect their price. Now you might be wondering, how do I actually buy a bond? Well, you can buy bonds directly through some brokers. Alternatively, you can also invest in bond funds, which pool together a variety of bonds. This can be a good way to diversify your bond investments. Finally, remember to regularly review and adjust your bond investments as your financial situation and the market conditions change. Investing is not a set-it-and-forget-it activity. It requires constant monitoring and adjustment. Choosing the right bonds can be a key component of a balanced investment portfolio. And with this knowledge, you're well on your way to becoming a savvy bond investor. Finally, let's talk about mutual funds. Imagine you're at a banquet, and instead of choosing just one dish, you're served a bit of everything. That's the essence of a mutual fund. Mutual funds are essentially a collection of investments, kind of like an investment basket. They pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other assets. Each investor in the fund owns shares, which represent a portion of the holdings. There are several types of mutual funds, each with its own flavor and purpose. Stock or equity funds invest in shares of companies. These can be further categorized into large cap, mid cap, and small cap funds, based on the size of the companies they invest in. Then we have sector funds, which focus on specific industries like technology, healthcare, or utilities. Bond funds, on the other hand, invest in debt securities like corporate bonds, government bonds, or municipal bonds. These funds aim to provide regular income to investors. Balanced or hybrid funds mix it up, investing in both stocks and bonds. The idea is to strike a balance between the potential for growth from stocks and the stability of bonds. There are also money market funds, which are perceived as safer and invest in short-term, high-quality investments issued by U.S. corporations and governments. And let's not forget about index funds and exchange-traded funds, or ETFs. These funds aim to mimic the performance of a specific index, like the S&P 500, providing a broad market exposure at a low cost. Each type of mutual fund comes with its own set of risks and rewards, and they cater to different investment goals and risk tolerance levels. But regardless of the type, all mutual funds are managed by professionals, known as fund managers, who decide what securities to buy or sell within the fund's portfolio. In a nutshell, mutual funds allow you to invest in a diverse range of assets without having to buy each one individually. But how do mutual funds work? Just imagine a giant pot of money. Now each investor contributes to this pot, buying shares of the mutual fund. The fund then uses this collected money to invest in a wide array of stocks, bonds, or other assets, depending on the fund's investment objective. This is how mutual funds aggregate money from multiple investors. The beauty of mutual funds lies in their ability to provide diversification. Instead of putting all your eggs in one basket by investing in a single stock or bond, mutual funds allow you to spread your investment across a broad range of assets. This can help reduce risk because even if one company in the fund's portfolio performs poorly, others might perform well, offsetting the losses. Now, let's talk about the net asset value, or NAV. It's a vital metric in the world of mutual funds. The NAV is simply the total value of all the securities in the portfolio, minus any liabilities, divided by the number of fund shares outstanding. It's calculated at the end of each trading day and gives you the price per share of the mutual fund. Performance of a mutual fund is another critical aspect. It's measured by the change in its NAV over time. Remember, a mutual fund's performance isn't just about the returns, it's also about how much risk the fund took to achieve those returns. And who manages all these? Well, mutual funds are managed by professionals known as fund managers. They make the day-to-day decisions about what securities to buy or sell. Their goal is to meet the fund's investment objectives and provide the best possible returns for investors. But remember, while mutual funds offer diversification and professional management, they come with fees. These can include management fees, distribution fees, and other expenses. Always make sure to understand these costs before investing. Therefore, mutual funds offer a way to achieve diversification and professional management in one package. So whether you're a seasoned investor or just starting out, mutual funds can be a valuable part of your investment strategy. What are the advantages and risks associated with mutual funds? This question is a vital piece of the puzzle when it comes to understanding the world of mutual funds. So let's dive in. One of the most significant advantages of mutual funds is diversification. Instead of putting all your eggs in one basket, mutual funds spread the risk across a wide range of stocks, bonds, or other assets. This means that even if one company in the fund's portfolio performs poorly, the impact on the overall fund can be minimal. Essentially, diversification can help stabilize your investment and potentially smooth out the bumps in the financial road. Another key advantage of mutual funds is professional management. Mutual funds are managed by experienced professionals who dedicate their time to researching, analyzing, and monitoring the market. They make the investment decisions on your behalf, saving you the time and stress of trying to navigate the complex financial markets on your own. However, everything that glitters is not gold. Mutual funds also come with their own set of risks and costs. One of these is the variability in performance. The performance of a mutual fund is dependent on the market conditions and the skill of the fund manager. If the manager's investment decisions don't pan out or the market takes a downturn, the value of the fund can decrease. Then there are the fees. Mutual funds charge management fees, which can eat into your returns over time. Some funds also have sales charges or loads that you pay when you buy or sell shares. These fees can vary widely from fund to fund, so it's important to understand them before you invest. In conclusion, mutual funds provide a way for investors to gain a diversified portfolio managed by professionals. This can make them an attractive option for both novice and experienced investors. However, like any investment, they are not without risks. While mutual funds offer many advantages, it's essential to understand their risks and costs. So, how can you start investing in mutual funds? Well, the first step is to understand your investment goals. Are you saving for retirement, a down payment on a home, or your child's education? The answer will help you determine the right type of mutual fund for you. There are various types of mutual funds to choose from, each with its own set of features, benefits, and risks. You have stock funds, bond funds, and balanced funds, which is a mix of stocks and bonds. It's essential to understand these differences when making your decision. Once you've determined the type of fund that aligns with your goals, you'll want to consider a few crucial factors. These include the fund's historical performance, fees, and the fund manager's reputation. While past performance is not a guarantee of future results, it can provide an insight into the fund's consistency and stability. But don't just stop at the numbers. It's also important to look at the fund's strategy and philosophy. Does it align with your own investment beliefs and risk tolerance? If the answer is yes, then you might be on the right track. Now let's talk about fees. Mutual funds typically charge a percentage of your investment as a management fee. While this might seem small over time, it can significantly eat into your returns. So it's essential to compare the fees of different funds before making your choice. Once you've picked the right mutual fund, the final step is to actually invest in it. This can be done through a retirement account like a 401(k) or an individual retirement account, also known as an IRA. Alternatively, you can invest directly with the mutual fund company or through a brokerage account. Remember, start with what you can afford and gradually increase your investments as your financial situation improves. The key is consistency and patience. Investing is a long-term game, and the real benefits of mutual funds come from the power of compounding over time. Remember, choosing the right mutual fund can have a significant impact on your investment returns. So, take your time, do your research, and make informed decisions. Good luck on your investment journey. To sum up, we've covered a lot of ground today. We've delved into the world of stocks, bonds, and mutual funds, exploring each one's unique attributes. Remember, stocks represent a share of a company, offering potential growth but with added volatility. Bonds, on the other hand, are like loans to corporations or governments, providing stability and regular income, though they come with their own set of risks. And then we have mutual funds, a kind of pooled investment managed by professionals that allows for diversification across a broad range of assets. Each of these investment vehicles has its own advantages and caveats, and the key to a successful investment strategy lies in understanding these nuances and diversifying your portfolio accordingly. Now it's your turn to take the first step in your investment journey. Start small, stay consistent, and keep learning. If you found this video helpful, please give it a thumbs up. Your likes help others discover these financial insights too. Don't forget to hit the subscribe button to stay updated with our latest content. Consider sharing this video with someone who may be interested in the world of investing. And if you have any thoughts or questions about stocks, bonds, or mutual funds, do leave a comment below. Thank you for your time today. I hope you found this video helpful, and I look forward to seeing you in the next one.